Hi everyone, welcome back to my channel. Today I want to begin an advanced priced action series that covers many concepts like order blocks, fair value gaps, smart money manipulation, and high volume hedge pressure zones in great detail. I'll be breaking it up into multiple videos to make it easier to consume over time. Before we get started, I'll leave several referral codes for trading services I use in the description, including TradingTix, Elite Trader Funding, and TradingView that will give us both discounts. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. That being said, let's get right into it. So today, before we get into order blocks, I actually need to cover market structure breaks. Now, I've talked about this concept before in my video, and it's an extraordinarily important concept because it leads to a lot of price action plays that we can use and that I'll be covering in this series. So from now on, you'll probably hear me refer to them as MSBs, which just means market structure breaks. And essentially all this is, which we can see in this chart, is we had an uptrend, or excuse me, we had a downtrend for some time. We can see here we made a lower low, lower high, and then we were chopping around, made a new lower low, and then all of a sudden we start making a higher low, and then we break past this previous point with strong price action, with strong bars, and begin the formation of an uptrend. Now, this happens because somewhere down in this area, and we'll get into it on the chart, this is the ES 15 minute, and I should stress that these concepts do work on any, whether it be stocks, options, crypto, forex, futures. All these concepts work, and a market structure break is one of the most fundamental concepts that we as traders should always be paying attention to because it creates many opportunities. And you can actually just make a living off of finding tickers that recently had market structure breaks and playing those market structure breaks with these concepts I'm going to cover. So in this case, this break formed the start of a new uptrend. Now, what I want to talk about with this, and it's something that I never really see talked about, and it's a way that we can measure this market structure break to find an entry zone. So, and I'll show how I did this on the chart, but what I did is I used fixed range volume profile, and I just basically drew it over this area where this market structure break occurred. And what we can see here is that when we came back and tested this zone, and we can see here I have the blue lines are the value areas, but most importantly we have these high volume nodes, this area where all these high volume nodes are, and it actually starts at this green line here, which might be hard to see, and I'll jump over to the chart to see if I can show that a little bit better. But the area I'm talking about was on ES, and it was a recent market structure break, and we can see this happened on the daily chart. And if we zoom in on the 15 minute, and I'll slide all the way over to that point where I drew this, so we can see here's the fixed range volume profile. Now, in order to measure this, and all trading platforms have this that I know of, I use it in both TradingView and TradingView, and I use it on a regular basis. On the left hand side, it might be somewhere different depending on your platform, but you can go to fixed range volume profile, and we can just cover this whole zone where that led to this market structure break essentially. And what we're mostly concerned with, I'll just drag this over some, is what if we come back and we retest this high volume area. We could see we're trying to figure out, okay, so here's all our high volume nodes, and basically I encompassed the area, this whole consolidation area, and then this uptrend. Now the reason why I wanted to cover the market structure break, and this is the point at which market structure technically had a strong break where we started making a strong higher high. The reason why I wanted to cover this area is because this is also where a lot of volume was being injected to help push price higher. So we're trying to identify the area that, okay, if we come back into these high volume nodes, this whole zone can be our entry zone. Now that does give us a very large entry zone. It's not always the case where we get a nice clean wick like this and we immediately bounce. It's totally possible that we could have come down to one of the value areas. We could have even come down to these higher volume nodes, to this POC, and usually that's what happens, is we'll actually come down to this POC and then get a bounce. Or we could have even came down all the way to the value area low, and it's sort of rare, but maybe even down here into this node. But essentially what we're doing is we want to draw an entry zone on a higher time frame, because we know that when we come back and we start coming down again, as long as we don't make a lower low here, as long as we don't just make this higher high and then just proceed to immediately break it, which is very rare in this situation where you have what's called a strong market structure break like this. And this causes fair value gaps and some other things that I'll get into in future videos. But essentially, as long as we don't make that lower low and we come back into this area to test it, we can look for our entry. Now, in order to do that, we want to make sure that we're doing this on a lower time frame, because that will help give us a more optimal entry. If we just stayed on the higher time frame, which in this case was the 15-minute, then, I mean, this was a pretty clear entry, but again, it doesn't always happen like this. We can see that we had, when we came down, as soon as we came down into this high volume node, we had this extremely high volume come in, this long wick form, and started pushing price higher, which would have been a great market entry, and our stop could have been below this value area low, or a little bit deeper depending on your risk. So I mean, it's rare that the higher time frame does show such a clean entry like that. What I usually like to do is go down to the lower time frame and look for my entry there. So if we do that, now you can do anywhere from 1 to 5 minute. I typically prefer the 3-minute chart, and we'll just scroll back over to that area here. So we can see, okay, so this is right at the point where this happened. So we marked our zone with this big rectangle. We could see price action started moving up, chopped around a bit, but the very next day after we had this market structure break occurred end of day. And this very next day, when we came down to test it, we can see what happened here, which is something I really, really like to see, is when we came down, we saw the candles getting smaller, we started to see buyer pressure form, and then we had a nice big green candle confirming the push out of that with this long wick, which is very similar to what we saw to the 15-minute, which would have been a great time to market. And then we just need to make sure, I mean, at this point, we basically get a whole move for the whole rest of the day. And this encompassed, I mean, we went all the way. If you had marketed in here, let's say you even did it late, so you marketed in around 39.60 after this 3-minute candle completed. Even though we do come down and test it a little bit, we proceed to rise all the way up to 40.10. So there's no reason why during this 50 point run that you shouldn't be trailing your stop every time we get a pivot. And one thing I've talked about before in volume price analysis videos is that these pivots, notice how as we're pushing higher, we're doing so on higher volume. And then when we come down on a pivot, it happens on diminishing volume. And then we proceed with our original move. And so we know that's a pivot. And every time we see a pivot complete and we start moving higher and we move out of that pivot, that's a good time to slide our stop loss up and just keep gradually sliding it up. And then eventually what happens is we come back down. Our stop loss gets triggered at some point depending on how aggressive you moved it, and we fall back down, and then again we hold again, and then we just proceed to essentially run and haven't really stopped running since. And it's just been a very powerful move, and we could have had an optimal entry rather than chasing the move on the market structure break, which is something I never like to do when we just break out of it like this, or if we break above this line. You can take an entry here. This was later in the day. Also, I tend to find that if I chase breaks, I mean, this was a break and retest on the lower time frame. It worked well, and all this happened the following day. So this essentially could have worked, but oftentimes if you chase breaks, you'll end up getting caught in a fake breakout, and it will reverse on you. So we always want to wait for a clean breakout and then essentially wait for a clean retest. And that's how we can identify our zone, by using fixed range volume profile to help us with that. Now, the thing is, when these big market structure breaks happen, they create what's called an order block, and that's a common concept you may or refer to, and that's basically saying they create an area where smart money or market makers are injecting a bunch of their own money, which is causing the trend to break. And again, this can happen long or short. I just have long examples here, and it causes the price to start moving higher. So we can see this was an area where we had been in a downtrend, and then at this point in the price action, it was enough where things started reversing. Now, it didn't reverse immediately, but we had two equal lows here, and then we started moving higher. And this is another area that if we wanted to measure it, we could, and I just want to show how that's done again. So if we go to this higher time frame in this area, we can see, and the previous example was indeed an order block zone. That's what we were measuring. I just want another example to show you another order block zone. So we can see here that price is falling, creating these fair value gaps, which is a concept I'll cover in the next video, which are critical. They fair value gaps are just so lucrative to trade. You could literally just trade fair value gaps and make a good living off of that. But so again, I did the same thing here. I just did it on the daily chart, and I measured this zone with the fixed range volume profile, which we can see here. I just take this consolidation zone and also cover the candle where the uptrend starts. We get our fixed range volume profile. And the reason I wanted to show this example, because this is a good example where if we take these high volume nodes, so we take the value area high, the POC, the value area low, and we can even capture these high volume nodes down here. And we just want to make sure, again, that when we're doing this, so in this case, since we're looking at the daily, we can actually drop down to the 15-minute time frame to look for this. So let me just slide all the way over to it. And we can see, again, this is why it's so important to use a lower time frame to take these entries, because we can see we come up and we come down to retest this large order block zone. The reason why this zone is so large is because I did this on the daily time frame. And I should note, these do work on all time frames. So if you're marking these market structure break zones where these order blocks cause market structure to shift, and you're doing it on the 30-minute, your zone's not going to be as large as if you were doing it on the daily chart. So we can see as we come down in here and we start holding, we initially get, and let me just delete this rectangle here so we can see the candles a little better, and I'll zoom in. But we could see when we start getting these hammer candles that indicating a hold, these are times where we want to enter as long as we're within our zone, and we can just set a stop loss below that pivot just in case we do go lower and deeper into that zone. And again, every time we tested, and it just so happens that once we tested that once, every time we came back into this zone, and even on follow-up days, we had another nice move off of it. And it did take a couple tests. You can see here it was two tests mainly to move higher. This did happen in the after hours, so it might have been missed, but at the same time, though, that would have been, we would have known that this is the area that we need to start looking for entries, and we need to start looking for candle patterns to help confirm those entries, which are going to be long wicks, higher volume candles that shift everything. Even if we didn't take this candle right away because we had a follow-up red candle, and this candle kind of looks as a fake out, as we started moving higher, even as we get in late and we were to break the top of this candle, we could take a market order entry in. Of course, the later you get in, the more chance of drawdown. So when we see these patterns that look like stopping patterns where price is getting hung up and they align with the zone that we had marked previously, that's when it's best to look to take our entry and then set a stop loss within reason in that zone. And so and this just basically covers that, how when we come into these order block zones, we see price showing a reaction here. We have 1, 2, 3 times where it touches and then moves higher. Once again, we have a couple touches within the zone, and these are called shooting stars. These really long wicks with these tight bodies, these are really especially when they're done on higher volume, those are candles that are a clear indication of stopping volume, that we're going to move higher. Again, this would be a great market order entry, or if we were playing off the daily chart at the close of the day when we saw this move, we could look to swing a position to the following day, or if we don't want to worry about theta, just open a position the next day. And so again, we already covered this, but we dropped to lower time frames to try to time these entries. This is a bit better view on the 30-minute chart, showing how as we fall into this zone, we can line up our entries as we get confirmation of hold, which actually it looks like there was 1, 2, 3, 4 chances to get in off this zone before we moved higher. And every single time we came down into this high volume zone, we just failed to move higher. And so your lower time frame is certainly going to give you better entries, more optimal entries, and they're going to allow for better stop losses if we focus on the higher volumes areas, which we could see here, which are the POCs usually right smack in the middle of a higher volume area. And we can see the high volume nodes on either side of it, and then we have a volume gap and then another high volume node area. But if we focus around the one with the most volume, this orange line is the point of control line, which shows that for us, we can see that's exactly where the optimal entry occurred in. So, and I just talk about the different stop losses you could potentially use. You could do it right below the high volume nodes. You could give yourself a little more room at the start of the next high volume node. So basically, after this gap, in case it does come down, because typically what will happen is price can come a little bit into this gap and move higher. So we would need a bit of a deeper stop here, and again, on higher time frames, that's sort of expected. When you're trading on very low time frames, scalping time frames like 1 to 5 minutes, our stop losses should not necessarily be that deep. The first stop is much more appropriate for a lower time frame. And then if you are okay with a lot of risk, then you could even have a stop at the bottom of the zone entirely, which is not something I would recommend. But it has shown that the deeper we make our stops typically, especially off of a high conviction play where we had a market structure break and we're coming down to test that prior zone, the deeper we allow our stops typically prevents us from getting stopped out too soon to move higher. But it's really up to you. I'm not recommending a deep stop ever. It's just something you need to decide for yourself. Stops that you're comfortable with within reason, that are based off actual historical data using something like volume profile. So that's all I'm going to cover in this video. I'm going to stop it here, and in the next video I'm going to talk about fair value gaps, which are a very powerful price action tool we can use in our trading. And as always, if you have any questions, let me know, and I appreciate you watching.